Good morning. Welcome to day 2 of ICISA Surety Week 2023. My name is Daniel De Burke. I'm the Head of Public Affairs for ICISA. We're going to talk today about regulatory change and some of the challenges facing the sector. That includes challenges of specific regulatory change, those things that are affecting our sector, those things that are affecting our clients, and also responding to the volume of change, which can be an issue for insurers and brokers and clients alike. So this conversation was held a little bit earlier than today due to the time differences of the people involved. So we've recorded the conversation we held, but we still have our questions and comment feature open. So please do drop in some questions and some comments as the conversation goes on, and we'll come back to those at the end. But I hope you enjoy our conversation. And as I said, please feel free to interact and let us know your thoughts. Okay. I'm really pleased to be hosting this conversation about responding to regulatory change today. Let me begin by just asking my fellow panelists to introduce themselves. Joe, why don't you start?
Hi everyone, so I'm Joe Shaw, a Senior Market Services Executive at the IUA, and most prominently for this talk, the Lead Secretariat on our relatively new Surety Committee. To give a bit of background, the IUA operates a number of committees for different classes of business, including trade credit, and surety is kind of newly sitting within our range of committees that we operate.
Excellent. Steve, how about you?
Yeah, good morning. I'm Steve Ness. I'm the President and Chief Operating Officer of the Surety Association of Canada, and we are the trade advocacy group representing the surety industry in Canada. And we are essentially in charge of everything surety from coast to coast, including regulatory matters.
Excellent. Well, clearly we have the right people for this discussion. We in ICISA, we cover a sort of a global overview, but a lot of our members are EU based, as well as Asia, Africa, North America, Latin America. But a good chunk of the regulation that our members face is European. So I'll probably cover a good chunk of that here in this discussion today. But I wanted to start by just giving a little bit of a background to why we're having this discussion. And I think it's an important topic. Regulation is always something that people are interested in. And for many people who are watching this conversation, maybe it's something that sits in the background behind all of your daily activities. It's something that you know about, or you know it affects you, but you don't necessarily have to worry about how things get implemented, how things change, and staying up on the discussions on a day-to-day basis. Ultimately, down the line, someone will tell you that a new rule has come in and you'll have to do something about it. But what about regulatory change? That's what we're talking about today. And when I've spoken to members and other people in the sector in the last few years, I think there's a growing pressure on insurers on a number of regulatory topics, and regulatory change can come in a few different forms, and I think we'll cover a lot of those in this discussion. One way is that it can be regulation that's directed or targeted at insurers themselves, or even just sureties. Alternatively, it could be regulation that impacts our clients or the sectors they work in. So you could imagine rules relating to construction businesses or the construction sector. And then there are rules that cut across everything. One of the most obvious ones of those nature is sustainability. And we're seeing a big push from regulators just across the board on that topic, as well as many others. But on top of individual changes to specific rules, members that I speak to on a regular basis also point out that the volume of change is a challenge itself. Keeping up with what's happening across the board, and that can also include monitoring developments in multiple jurisdictions, can be a real challenge for even the largest of our members. And that's something we hear on a regular basis. So we're going to address some of these points today. What are the major topics we see facing the sector? How are we responding to some of the major thematic issues of the day? And what can we do to ease our burden and take proactive steps, including around engagement with key stakeholders like regulators? But Steve, perhaps I can start with you, and we'll take a look maybe at the Canadian market. I know you cover both federal and provincial, but what would you say are some of the major developments that are keeping you up at night, or maybe just on your agenda?
We don't have time for that, but I will give you one very hot potato current item that we're wrestling with at the moment. I have to give you a bit of background first. Surety companies in Canada are regulated and licensed by the federal government, specifically under the Office of the Superintendent of Financial Institutions, and that's where we all get our licenses to operate. And so far, so good. We have. We're not a big market. I think we have 22 sureties, and that's about 97% of the market. Now, licensing is one thing, but there's another body, another federal ministry, the Treasury Board Secretariat, who regulates all the government contracting policies. And they had, had is the past tense, a very, very broad regulatory framework. It was called the Contracting Policy for Canada. An appendix to that policy was a list of the sureties that are eligible, not just licensed, but eligible to write bonds for the government of Canada. Right. So those are two different regimes. Now, let's add in a third government body, and those are the bodies who actually call for the bonds, the end users, the Public Works Canada, the Customs Canada. All of them universally have this procurement policy saying that, yes, in order to write a bond for the government of Canada, you must appear on this list by the Treasury Board. Now, all was well and good for about a half a century. And then in May of 22, the Treasury Board rescinded its contracting policy, replaced it with two or three other splinter policies. However, that list of acceptable bonding companies did not appear anywhere. So we have the government of Canada demanding that any surety company issuing a bond for them appear on a list that no longer exists. So right now, we don't have a surety company. Technically, there's not a surety company in Canada that's eligible to write bonds for the government of Canada. And we've gently and more recently, not so gently, pointed out to them, something needs to be done here. Now, we propose that forget the list altogether. We don't really need it. We can simply rely on the licensing regime. However, governments, most of them, the left hand doesn't know what the right hand's doing. Well, in our case, the left hand doesn't know what the left hand's doing. And they don't talk to each other. And again, as we all know, governments work at two speeds, slow and not at all. And they just haven't caught on to this yet. So right now we're operating in limbo. We hope to have this resolved sometime before the next millennium. Right now we're going along as if that policy was never rescinded, even though it has. So there's a conundrum we've got.
Yeah, I think it's an issue, an interesting point, isn't it? That sometimes the issues that we face are specific rules that are really concrete and they may pose challenges. But then sometimes it's the lack of clarity, it's the lack of certainty that can be an even bigger challenge for us as an industry.
Just avoid.
Yeah, exactly. Joe, I think you and I share some common topics as well. You're obviously based in the UK, but have a bit of an international focus as well. What types of things are you keeping an eye on at the moment?
Well, I think it's interesting they're talking about policies and regulation that kind of impact you just because they haven't thought about surety. I think we might discuss that a bit more later, but certainly the majority of regulation that we're looking at is stuff that will impact surety, or at least will have a secondary impact on surety, but hasn't directly considered sureties. Even where it's considered insurance companies, those insurance companies may write surety, but as any surety practitioner will tell you, it's a very different way of doing things. But I think it's difficult to talk about the UK without mentioning Brexit still, because there's a lot of conversations now about what post-Brexit UK regulation looks like. I think one that comes up quite a lot in terms of what we're questioned about is Solvency II. What is the UK doing in respect of Solvency II? The concern there, I think, for most insurance companies and most businesses, to be honest, is just is there going to be variations? Are you going to diverge from what the EU is doing? Because there's a lot of proposals about improving the regulation or improving regulation, making it better in the UK, but the concern is always the unintended consequences. But certainly with Solvency II, I think, and speaking to our legal and regulatory team, we're relatively positive on that at the moment. The changes that are being proposed won't impact the surety market and general insurance in any way that we can see negatively. I think that there are more implications for the life market, but certainly the proposals that we're seeing will modernize it. And there's been examples where the regulator may have had to request data because there was an EU rule to do so. It's not using that data. It makes sense to diverge and say, actually, we don't need to request that data. That's a positive move. And I'm sure most insurers, when you're talking about data requests from regulators, will often say, what are they doing with this data? And our regulators say, actually, we weren't doing anything with it. So that's a positive move. And certainly we've had really good conversations with the PRA and the FCA, and we have regular meetings with them as IUA. So that's an area where things are looking perhaps more positive than people might have been concerned about. And I think the view that we've put forward is, yes, we're supporting a lot of these proposals that are coming out. And if the EU and the UK end up in a similar position, just in different ways, that's positive. And I mean, Brexit for our members, the biggest impact is you've just got a lot of different regulators that might now you need to look at what they're proposing. At the moment, I don't think we've seen anything that's been a massive issue, but there's always the concern that if you're doing business in one country now and branching into another one and having to get licenses depending on where you're based, that creates additional concerns. So that's something we're discussing, something we're monitoring at our surety committee meetings. There's always the potential for in a wider Brexit kind of post-Brexit scenario that certain regulators don't like what the UK is doing. There's very little we can do about that, and that's a bit unpredictable, but it is a concern. I mean, I think that kind of gives an overview of what we're looking at in terms of Solvency II, and hopefully that's some of the good news. That we're not expecting the UK kind of regulatory regime to completely break.
Yeah, I guess that's a good thing to hear from all sides of the channel as well. I think people on the EU side will be pleased to hear that it's going to stay somewhat similar. There's obviously areas that divergence will occur naturally. I guess that's one of the things to keep an eye on in the longer term is where other changes might take place. One thing that, and both of you were involved in Surety Week last year, which was we're really grateful that you're back again. One thing that you both discussed last time and was around the UK looking at its regime around bonding percentages as well. I know that's something that you've looked at, Joe, within the IUA. What can you say about where that is at the moment and where might things go in the future?
Yeah, I mean, I think, you mentioned the panel session that we were involved with last year, which was essentially a dual panel session looking at what Canada did, what the UK could potentially learn from that, and kind of building on us having a new regulatory regime. Hope that the UK government is in a as well as changing all of the time, is looking at ways to improve the UK economy. They're much more receptive to ideas coming in that make sense. So we were looking at the Canadian model, Ontario, looking at what we could learn from that for the UK. Some of that was driven by some of the big losses in kind of in contractors that we've seen in the UK. And without wanting to go into too much detail, I think there was a sense that type of thing happening more regularly is just not going to be sustainable. So we were looking at surety, which is generally, I think, a product that we can look at and say it does what it says. We're kind of talking about regulation. We're a well-regulated industry in terms of the insurance and surety industry. And if we've got a product that works here, is there something that can we do more with this to help with these situations, to provide either additional products or additional support? the biggest obstacle to that, when we started looking at that and discussing that, is data and models. If you're going to make an argument for something, you've got to have the data, models, information to back that up. And I think that's definitely one of the weak spots that we've got in the UK surety market. Certainly, compared to Canada, compared to the US, we don't have those resources to look at and say, here are all the figures, here's what we're proposing, and here's something to back it up. So we engaged with Cancia, which was the firm that looked at in Canada at looking at their bond percentages, and they produced a data-driven or an agent-based model, which was very impressive. We had a conversation with them about what they were proposing to do. Agreed a contract with them, which was with our members, but agreed essentially through IUA. And the current stage is that they've built that model, kind of having a few presentations at the moment before moving into what kind of which I say scenarios, and then I'm told by the data scientists and the people working on that it's not a scenario. It's putting in possibilities, but I won't delve into too much detail on the science behind it. But yeah, we'll plug in some potential outputs to get some of that data out of there, and I think that we'll then have discussions about what we want to do in terms of lobbying. But essentially, that will give us the data to show us if we change bond percentages, if we change the types of products being offered, change what was maybe mandated in the UK, what is the impact of that? Yeah. And that data will show us not just the direct impact, but also the secondary impacts throughout the entire economy of the UK. So it's really impressive data. It's really useful for us, and it will help us make some educated lobbying, if there is such a thing, once we get to that stage.
Yeah, Steve, I know it's a topic that you were well aware of from the experience in Canada as well, and I guess things like data and making a lot of contact with the key people in the government, the regulators. I think that was probably key from your perspective. Would you say?
Yes, it was. That Cancia report, they did that for us in 2017, right. And their work was instrumental in us securing with the province of Ontario legislation and a regulatory regime that made surety bonding mandatory on public construction work in the province. Right. We were able to demonstrate to them that governments benefit all the way around, in enhanced tax revenue. In fact, Cancia was able to demonstrate that in very difficult economic times, governments can actually make money by accepting bonds, for the simple reason that in the event of a contractor's failure, the asset will be online and producing quicker, generating tax revenue. And the claimants, the subcontractors and suppliers, will all be paid, thereby preventing insolvencies and the ripple effect on the economy that would bring about. So in Cancia, I can't say enough about them. I mean, I paid a king's ransom to get it, but it's been worth its weight in gold. So yeah, that's great. I would very much, Joe, I would like to see the upshot of Cancia's work in the UK when that's available.
Yeah. And I think it kind of highlights an important point about regulation when it comes to the surety sector is, and probably this is where there's a difference between what I do in my day job looking at credit insurance as well as surety, is that surety tends to be very specific to each jurisdiction, whereas credit insurance, I think the experience is a bit more similar across countries, even though there are kind of unique features as well in each market. But there's also things that we can learn from different markets. What has worked in one market, what didn't work in another market, and then also where there are maybe similar legal philosophies as well that can kind of help with taking one idea from a market and applying it in another. When I look at my day job within ICISA and what am I looking at, what's filling up my inbox, there are a few things, and you mentioned Solvency II, Joe. I know you're looking at it from the UK's version of Solvency II. I'm looking at it from the EU's version of it, and that's in the middle of a big ongoing review. And we've been following the proposed changes that are being proposed there to the regime for some time now, and it's at quite an advanced stage within discussions both within the European Parliament, the European Commission, and actually also in the European Council. The most important ones at the moment, right, as we're talking today, are in the European Parliament. That's where a version that was initially published by the Commission is then reviewed by both the European Council, which represents the governments, and the European Parliament, which has all the individual people who are put there by citizens around the EU. And the European Parliament version is going through a few different stages of compromise, text agreement. It's taking quite a while, and it doesn't seem like an answer is immediately apparent where that will get to. But there's no deadline either, so that's one of the difficulties in the conversation. But we also know that there's pressure internally to move on towards what's called a trilogue, which is basically a conversation between the Council, the Commission, and the Parliament to get something done and come up with a final text. We broadly know what areas will be addressed. We broadly know which bits that we're interested in, but how things pan out in the final text, I think that's something that is still a little bit up in the air. And I think, as you said, Joe, there's nothing in it in the EU version that is screaming out as a big issue for the surety sector. That's obviously a good thing. We don't want anything where we're being picked out or kind of identified separately. But the other side of that is that sometimes when rules are applied across the board, then things like credit and surety, which don't look the exact same as everything else in the sector, that can be a challenge then to apply those rules to our members. But we're keeping an eye on that, and we're hopeful that things shouldn't change drastically. But there will be some changes in how European businesses are supervised. There's a few areas that will definitely get more focus. Systemic risk is one. That's something that we're seeing just an awful lot more focus on, both at the EU level and in lots of other jurisdictions. The IAIS, the International Association of Insurance Supervisors, has been looking at this topic for a long time. And even though the insurance sector has long said that systemic risk is much less of an issue than in the banking sector, which is probably true, the regulators are still concerned about this, and they want to make sure that they're doing something about it. And I think the pain of the global financial crisis is still there and driving a lot of that work. We're also seeing greater requirements are likely to come in for firms that are using internal models versus the standard formula. That's likely to see an increase in some burden for members who are using an internal model. It could see more requirements that point them in direction of the standard formula, and deviation from the standard formula could become an issue to some extent. And we're also seeing the obvious link to climate risk and sustainability, where there's likely to be more treatment around that. As I said, I think final texts we may see something towards the end of the summer. But it kind of all depends how those conversations in the Parliament go. That's where the block is at the moment. Interestingly, we also, and I know, Joe, you've seen a lot of political change recently, and obviously that can affect things. The Commission and the Parliament are due to change in 2024. And obviously we're coming up to that pretty quickly. So depending on where things get, that could potentially end up being a roadblock to really getting these advanced. I think there's a lot of pressure to get these done, particularly another area that's of interest to members, which is around the banking framework. And that involves the implementation of the Basel III or IV rules, depending on how you like to describe them. But that has some potential to impact members, and I know a lot of people are keeping an eye on that too. Overall, I think what the issue there is that there's likely to be some change to the bank's interaction with certain counterparties for credit relief, for credit risk mitigation, and that could have an impact both on credit and surety. We're not exactly sure what the impact at this stage may be on surety, but it's definitely an element that is being looked at and may lead to some changes, and hopefully it doesn't lead to major negative impact on how banks interact with sureties. But it's something we're keeping an eye on. If I look outside of Europe as well, there are plenty of things happening as well. One of the things that we discussed in Surety Week last year was the development of surety guidelines in India, and that's something that was widely hailed as a positive development there, opening up the market to sureties to be able to do business. It was noted at the time that there were some restrictions in those rules that may be problematic and that may slow down the development. And I think, unfortunately, that's probably been the case, that things haven't progressed as fast as particularly the government and the Ministry for Transport or for Rail in India would have liked. And there's been a lot of discussion in Indian media about the need for sureties to be involved. There is some concern about things like recourse, what sureties can do there within the guidelines. There's a lack of clarity. And also the link to things like the insolvency laws in India as well. But I think there is an interest in getting these things right. They see the value, and that's one of the key things. They see a value in surety and want to be able to progress on this.
Daniel, was there not in India? Was there not also concerns around ownership of the insurer surety in terms of extent of domestic ownership that was prohibitive to offshore investors?
Yeah, there's in the insurance rules in general, there are some restrictions on the percentage that can be foreign owned for insurance companies in India. I think there are also some restrictions about the percentage of your business that would be purely surety, where I'm not sure what the exact percentage was, but if you were a pure surety, I don't think the rules would allow you to basically do surety in India. That I understand their reasoning for that initially is that they want to make sure that large, well managed players are involved in the market. But the downside of that is pretty obvious, that people who are very expert in this area then could be restricted. I haven't seen where those changes have gotten to in recent times, and if there's some movement on that, but it's something that we're monitoring. And I know I've had questions from members on this topic in recent weeks as well, so it's something we're looking to follow up. And actually, the Indian regulatory, the Insurance Regulatory and Development Authority of India, the regulator there, has actually been very open to conversation on this topic. So that's something we're hoping to continue with in the next few months. If I then kind of shift gear a little bit and look at other types of regulation that are impacting the sector, we've looked at a few things that are quite specific to us. But there's also a lot of things, and we've touched on sustainability being one of them, where these are things that are impacting across the board. They're things that are coming for the financial services sector, for the insurance sector, and also for our members' clients as well. Steve, I was just wondering, what do you see when it comes to sustainability in Canada? Is it something that is a priority at the moment for regulators? Is it something you're seeing concrete rules, or where is it?
Now, you're talking about regulations imposed on other sectors that just impact the surety industry.
Or even for the sureties themselves. I don't know if there's anything that is targeted at the insurance sector also.
Well, I mean, we've seen there's been a trend in Canada, and I briefly mentioned this. It started out with Ontario, which resulted in our very happy outcome with the mandatory bonding. But as a result of that, there's been movements across the country, and this is more affecting the construction industry, toward prompt payment regimes. Regulations, laws and regulations being amended to require that payment on construction projects of construction funds be made within a set short time frame. And that's still taking place as we speak. And Ontario was the first out of the gate, and that only really took effect in 2019. So we're not seeing yet the full impact of what it's going to be. But where it comes to impact us is that in the event that the prompt payment guidelines aren't met, are we going to see a spike in claims on payment bonds? We haven't noticed it yet, but the pandemic sort of threw all that out of whack. And now that things are coming back to some version of normal, some of our members are reporting that they're seeing not so much the claims, but the the hubbub that happens before failures. So yes, there is that.
I guess that's exactly right. That there are lots of these things out there that aren't targeted specifically to us, but do have that big impact. One of the things that I've been thinking about a lot is about disclosure requirements recently. That's something we're seeing a lot in Europe related to climate risk. I don't know if that's something you're also seeing in Canada. Is it?
That hasn't hit my radar.
Yeah, not so much. I know in the US, the NAIC, the National Association of Insurance Commissioners, adopted TCFD standards around disclosure of climate risks. I think this is something that's kind of at some pace spreading around the world, but I wouldn't be surprised if it ends up on your table at some point in the next while. Joe, how about you? Either cross-cutting issues or specifically sustainability or anything else? What are you seeing on those kind of thematic issues?
Yeah, I mean, I'll maybe start on the sustainability angle, because it's being discussed everywhere. But in terms of the tangible impact, it's very difficult to really put your finger on something that's actually changing at the moment. But I mean, it's not just surety. I mean, a lot of what we're seeing in terms of ESG more broadly, and that's bigger than just climate. But even just specifically on the climate issue, things like greenwashing, we're seeing very high level, either regulator or potentially wider insurance company led initiatives, and that might be kind of from the global head office, and that's being filtered downwards. So we're seeing a lot of policies, a lot of commitments, and it's a real question for individual practitioners about what that means for your class of business. And I think for surety, if you're looking at big construction projects and the types of things that surety are used for, it's quite a difficult question to say, how are we going to be compliant with what our company's saying, with what our regulator's saying? And we're certainly see from, for example, the PRA, what they're asking firms to do is to put ESG and climate risk at the heart of their business practices. So that's quite a high level ask. It's not very specific. They're not really. The FCA is starting to be a bit more specific, particularly with greenwashing, about things they want to see implemented. But it's very, very much high level principles at the moment that I think firms are reacting to. And as much as anything, there are business opportunities in relation to ESG and ESG products, and there's obviously branding implications for firms. And again, that goes outside of surety. That's how insurance companies want to be perceived, or what they want to do in relation to ESG. But certainly there's a lot of conversations still to be had about what that means on an individual level. And I think, as Steve mentioned earlier, it's not just the direct financial services and insurance company type direct issues. It's what's going on in the construction market. That's probably what's going to have the biggest impact, because there's going to be rules that the contractors have to abide by, regulations that they will have to meet. And we all know that surety firms do. And one of the big selling points of surety is the amount of checks and due diligence that they do. So if firms are not meeting requirements that they should be meeting, it's going to be very difficult for a surety to then offer a product, because as much as anything, that presents a risk for that contractor and the work that they're doing. And I thought it briefly worth mentioning the Building Safety Act, which has come into effect. Well, actually, there's some bits of it are in effect, and there are other bits that are coming into effect across the next year and a half. But that's put a lot of extra requirements on, particularly on certain types of. It applies more broadly, but obviously it was directed and brought in to deal with cladding following the Grenfell incident. But that changes the landscape a little bit in terms of how buildings are put together. It should make it a safer risk. So actually, there's a lot in here that surety should be looking at and saying, this is good extra regulation for contractors. Building, and anyone involved in the building process, that's a positive. It should make for a better risk. It should make for better buildings. But there's a couple of interesting angles there with remediation orders, and I don't want to go into too much detail on that, but essentially it's basically asking contractors to pay for some of the cladding costs, and it's enforced, and you won't get any public works unless you are a part of this. That presents a risk potentially to some contractors where they can't afford to do that. I mean, we know that certain contractors operate really tiny kind of cash flow margins. Again, I think sureties are being one step removed. I think most sureties will be very up to speed on the impacts of this, and essentially you'll look at a contractor and you decide, look at a project, you'll decide whether you want to bond it or not. So I think a lot of that stuff should come to light, but it does change the landscape a little bit. I mean, one of the things that comes in with the Building Safety Act is in respect of joint ventures, where you can go. It allows for, particularly in respect of cladding, to go directly after a firm that set up a special purpose vehicle. Right. So there's no it's kind of piercing the corporate veil. There's no right. divide there, and that's an interesting development, because it changes the type of risk that foreign companies coming in might want to do. And obviously there's a huge amount of projects where you've got foreign companies involved, and they're a big part of the landscape there. So there's a lot of stuff going on, but I think kind of what I've said there kind of exemplifies that there's no direct, there's very, very little where you see a piece of regulation and it mentions surety.
But usually when it does, it's not good news for us.
Exactly. I mean, normally we don't want that to be the case, but it does mean that there's a huge amount of regulation that's put in, and people or regulators, government, don't necessarily think about surety, or as has been the case in insurance, they think we'll just respond. And we are very good at adapting to change. That's insurance, surety. That's one of the things we're very, very good at as an industry. But it does present a challenge where you've got a lot of stuff where it kind of falls on individual firms, associations, insurance and surety specific bodies to work out, what does this mean?
Yeah, I think that's a really good point. And I think overall, I think there's a similar story that I'm seeing in other markets as well. One of the interesting things that's coming out of the EU at the moment is that there's a consultation open at the moment looking at a sort of minimal harmonization of insolvency rules within the EU. Obviously, this could have some impact on sureties, but also specific kind of changes that may be made to individual countries within Europe. So the insolvency regimes in each member state are quite different. This is intending to kind of clarify some of the rules, and some of it relates to the pandemic, where there was quite a different approach taken in different countries to insolvency proceedings, with some countries completely suspending them during that period. So we'll have to see where that one is going, but it's one to keep an eye on. And then also on to come back to sustainability briefly, that's something that we are seeing a lot more work on. Within the insurance sector, IOPA has published a discussion paper. This is stemming from something that's in the Commission proposals for Solvency II, but IOPA is not wasting any time and is getting ahead of the curve and has a discussion paper out about the prudential treatment of sustainability. So whether there should be, for example, a different prudential treatment for certain assets because they may be impacted by climate change as stranded assets and things like that. And also, it's also looking at both sides of the balance sheet. So a lot of focus has been in regulation on the investment side. This is also starting to look at the liability side, whether there would be some sort of change to your capital position as a result of being very heavily focused on kind of dirtier industries. And I think when you look at our sector, that's somewhere where there could be some impact down the line. So that's definitely one to keep an eye on. I think if we look then, and we've touched on it a few times, is one of the issues we have is that sometimes we're just not understood as a sector. That goes not just for regulators, say, of the rules you mentioned, say in the construction sector, but sometimes our own regulators don't understand this. When we look at credit and surety in Europe, we're a small part of a very large industry. And we can't always expect that regulators know about our lines, know how they work, and know how they might be different. Is that something that you see in your market? Are we misunderstood? Steve, do you think you're misunderstood in Canada?
Absolutely. Not just misunderstood, but ununderstood. Not understood. Yeah. And it's probably half of my waking hours are devoted to rectifying that with not just the regulators, but even end users of our product who rely on it, even the people that buy it. It's remember that particularly in the construction sector, I've always reminded our members that surety is this much of a problem, that big.
Yeah.
And will be the last thing anyone thinks of, because let's face it, nobody's ever going to fail, right? I mean, no contractor in the history of construction has ever failed until they do. And they don't think about us until something happens, and then we're the only thing they think about. So it's an inherent problem in our business across the board, just by the nature of what we do. And that instance I spoke about off the top about the licensing and the authorization, I mean, that's a clear case of changes made around contracting, largely construction, but not just. And with it, the surety list disappeared. We were just collateral damage. I don't think anyone gave us 2 seconds thought. And it's something, I don't know if that's Joe's experience, but I think it's, I know it is, it's so in the States as well. It's just something that we have to live with doing what we do.
Yeah, I guess it's one of the reasons that we're paid to do what we do, is to help.
Why we have jobs, Daniel.
Yeah, exactly. Joe, what do you think? What do you think that's a challenge for you in the UK?
Yeah, I think I completely agree with what Steve has said there. You know, I kind of mentioned earlier that we have probably in the time that I've been here as good a relationship with our direct regulators in terms of the PRA and the FCA. It's as good as it's ever been. Some of that has been driven by the fact that we've needed to have a lot more discussions, both during the pandemic and then before that, looking at Brexit rules. But certainly, yeah, the more specific you get, whether it gets to even insurance, you'll find that the UK government won't necessarily understand all the implications. They'll be asking after the fact. I think Steve mentioned there in terms of there's only really focus on it after something bad has happened and you need to use the product. We found that with insurance, and then more specifically with surety, the pool gets even smaller. So it's not so much that there's kind of deliberate ignorance anywhere, but it's just that it doesn't come up as often. And so you do find it having to make educational presentations. You have to, once you've got a problem, you have to go all the way back to basics and explain who the surety market is, what they do, what the impact is, and it means that it takes longer to implement any change or have any conversations. And that's not really, I wouldn't say that's necessarily anyone's fault, because I think we've all seen that there's quite a lot of turnover in staff pretty much everywhere at the moment, but particularly within regulators. And you can bring somebody up to speed and bring them along the journey of what you're trying to achieve, and you sometimes have to restart that multiple times. If you've got a big project that goes over multiple years, that can often be a problem. And again, that's not necessarily anyone not wanting to listen. It's just a fact of staff turnover. And in terms of, I think we mentioned in terms of issues that come along and you kind of get caught in the crossfire a little bit. And not to go back to Brexit too much, but looking at the kind of repealing of EU laws, that's one area where we definitely would be concerned about widespread changes where there hasn't been a consideration about how certain regulations impact other regulations, how certain rules might be reliant on other rules being in place. And we see that quite a lot. So there is concern there that we don't rush that process, because we don't want to find that there's a rule that sureties relied on, and suddenly something doesn't work properly, because it becomes very, very difficult if you need to get a new law in place, even within the UK, where it should be slightly easier in theory, with it being more flexible. But it's just being aware of that, but before the fact. And I think, as you both said, hopefully that's kind of the role that we play, and we can offer some value there. So that's not to say if everything breaks, it's our fault, but just want to clarify that.
Yeah, for sure. But it's an interesting way of putting it as well, because I guess as a sector, we tend to, if we're ever in the newspapers, it's usually because something bad has happened, and surety is kind of referenced in the background of that. And it's the same on the credit insurance side. We tend to be known in the newspapers when something goes wrong, which means that we're often fighting to shape the agenda when it's already out of our control. I guess that's one of the challenges for not just us as organizations that represent the sector, but also for our members, that they have this constant reputational management issue that they need to keep an eye on. It can be quite comfortable to sit back and not have people worrying about your sector. But then, as I said, the tide can change kind of quickly, and people can get concerned about things. And also, if they only have a minor understanding of what your role is, then that can turn into a major concern that they might have as well.
I've always said we're in when we get called in, we're behind the 8 ball almost no matter what we do, because we're not in the business of making people happy. We can only make them less unhappy. And let's face it, once we move in, it's already an unhappy situation. Hence, we usually get, we usually wear the bad guy cloak, and it ain't fair, but it again goes with the territory.
Yeah, and I think for sure, and I've spent some time working in the UK government previously on secondment at one point, and everyone I came across there was curious, was knowledgeable of the financial services sector overall, wanted to learn more, but they had limited time to do it. They had lots of other priorities, and particularly when you think about what's happening at the moment, even if you're a policy specialist on a particular topic in the insurance sector, you're going to have a lot of pressure when it comes to things like macroeconomics, so what's happening on inflation. I recently met some government officials who we had a long conversation, but their main interest was understanding what's happening in Ukraine related to the conflict, and whether insurers were continuing to provide services in that space. People are interested in things like sanctions. That's another one of these kind of cross-cutting topics that is a big problem for a lot of people, trying to figure out who has ultimate ownership of different things. So there's a lot of people out there within regulators, within governments, who are really intelligent, know what they're talking about, but they have limited time. So we have to be on the ball, and our members have to be aware of what's happening as well, and build those relationships too. And getting time can be challenging. Some of that comes down to proving that we're relevant, proving our value to the world. I know one of the other sessions during the week, we're really pleased that Lee Covington is going to be able to talk about some research that they did on the value of surety in the SFAA. I think that's exactly the type of thing that we as an industry need to look at, telling the story about our sector, making people aware of the important role that our members play and that surety plays in the economy, and really starting to get people aware on a more regular basis, so that when things happen, we maybe aren't starting behind the 8 ball, maybe it's the 2 or the 3 that we're starting behind, and we can work a little bit easier from there. But I think that's something that we need to do. I don't know if we look then towards the future or suggestions, what do you think we can do, both of you, to sort of improve the understanding of the sector? What do you think has worked best? Steve, let's start with you there.
I mean, we've tried to be proactive. I guess it was in 21. We took some of the work that we'd done in Ontario, and we established a new suite of bond words, a bond language for performance and payment bonds that are much more responsive to our end users' needs, both in terms of timeliness and clarity. Here's what you can expect when you make a claim. Here's when you can expect it. And so we pushed those out the door. We're also looking to have those standardized across Canada, and I think we're very close to that. And so I guess there's that measure of productivity. And the other is, keep hammering away the message. And what you said a moment ago, I think, Daniel, resonated to me about the vast turnover. It got driven home to me just recently. We did a big presentation to one of our provincial governments, to their entire procurement branch. And myself and my Western director, Surety 101, here's what it can do for you. We sang our own praises and so on. And we had done the same presentation just before the pandemic hit. I think it was 18 or 19. And there was about 60 people in that room. There wasn't one person that was at the session a couple of weeks ago that was there back then. So it was 100% turnover. And that's the kind of thing we face every day. It's that constant, I mean, you have to re-educate or educate constantly, because it's never going to be the same people. So keep driving home the message.
Yeah. Joe, any final thoughts from you?
Well, I think I completely agree with what Steve said there. Is I think probably just to add to it a little bit, what we would see as key, and part of the work that we're doing with cancer and making sure we have the right data and showing the value of the product is really narrowing down what message we want to put across, and making sure that, I think we mentioned earlier about surety not necessarily being at the front of everyone's minds, and we don't want to necessarily put it at the front of everyone's minds just for the sake of it, because that's where you get some unintended consequences, where you get people thinking and doing their own kind of research and coming to their own conclusions. So we want to be quite clear about what we want, what the surety industry wants to do. And part of that is obviously making sure that we collectively do that. And I think firms, it's probably the same with both of your members. Firms want to come together and have collective messages about what we want to achieve and how we want to improve the industry, and really pushing out the value of surety as a product, because it is. I think the more you talk to regulators, to governments, to other bodies about surety as a product, it is very effective. It almost always does what it sets out to do. And it does have a big impact, and we've obviously got the benefit of a well-regulated industry behind that. So we really want to kind of make sure that we've got the key messages going across, and pushing things in the right direction. I think it's an interesting one in terms of how we get that message across, because I think we need to be. I think we've certainly found that we definitely want to make sure that there's data behind it as well. I think that's the thing that really gets people thinking about the industry, and really kind of hammers home those points, is when you can provide the data and say, here's what we're doing, here's the impact, and here's why you should be thinking about us a bit more.
Yeah, for sure. And I think if I had one thing that I'd recommend to members or to insurers looking in, or even to the broking community as well, it's that it's too late once these things already happen. You have to be involved in the discussion at an early stage. And that, as you said, Joe, includes data. It includes case studies, examples. And as Steve said, it involves having regular conversations. I think a lot of insurers sometimes are relying on other people to have those conversations, and I think that's something that maybe the sector can improve on, is pushing out at the boat and starting to have those conversations. I think we're just about finished now, so I'm going to wrap up by just saying thanks so much to Joe and to Steve for their comments and for all they've had to add to this discussion. I hope it's been helpful, and hopefully we'll see you again next year for Surety Week in 2024.
Thank you.
Thank you very much.
So thanks again to Joe and to Steve for their contributions to that discussion. Hopefully you found that helpful. As you see, we covered quite a lot of ground, and I think that was only the tip of the iceberg. There's also a huge amount of things going on in the US and in lots of other markets that we weren't able to get to. But there's a huge amount of things happening around the world that we're trying to stay on top of. We have time for just a couple of questions that have come in throughout the session. One is about, is there room for the surety community to have a common voice and approach bodies such as the WTO, EU, NAFTA, and regional economic groups to standardize the approach to sureties? I think that's a very good point. I think yes is the answer. I think there's no single organization that does that. We obviously are a global organization for sureties themselves. We work very closely with lots of other associations. I know there's also lots of broking associations internationally as well, and we need to form these coalitions to have those kind of, make those points. On that topic itself, I think one of the challenges there is that there is a lot of difference between countries on a few different areas, the way they treat surety. Some of it has to do with the regulation around surety itself. Some of it has to do with insolvency practices in different markets. So there's probably a limit to what extent you can standardize the approach, but there's definitely elements of best practice that we can promote across the industry towards those types of bodies. And we were already starting to open some of those doors at the moment, and hopefully we can partner with lots of other associations and lots of other organizations who have an interest in those topics. We also had another question about if there are regular updates on this kind of information, if there's somewhere that people can find what's happening on some of those topics that we discussed. Yes is the answer. We are providing a lot more overviews on our own website on ICISA.org. In our news section and in different sections there, you can find latest updates from us about what's happening and how it might impact the sector. And that's something that we're going to do a lot more of. I think we need to help you as people in the sector to understand what we're seeing in our conversations with regulators, and to make sure that everyone in the industry is on the same page as well, where that is beneficial to us. I think that's all we have for questions at the moment. There is a question about sustainability that came in, but we will be covering sustainability and particularly that question in another session later on. So to that person, I would ask you to join us for that session, which I believe is on Thursday. Later today at 3 p.m. Central European time, we have another session on the impact of inflation and responding to the challenge that high inflation that we're seeing at the moment has. That should be a really interesting discussion, and my dog won't be part of that discussion. You may have heard him in this one, but we hope that you can join us, and please make sure to register for all sessions. Even if you're not able to attend, you will receive a link to review the conversation back again later, and share it with colleagues as well. So thank you very much for joining us. I hope you found this helpful, and see you again later today. Bye.